Okay, I think that's quite a lot of you joined now, so we can go ahead and get started. So, hello everyone, and welcome to this masterclass on private equity and funds with Baker McKenzie. We're excited to have you here this afternoon for this exciting session, and hope that you enjoy this masterclass and find it informative. We always start our masterclasses with our learning outcomes. So by the end of this masterclass, you should understand what private equity funds is, learn more about what the work of lawyers at Baker McKenzie is in this practice area, and learn more about some of the key challenges and issues that arise when working on international private equity fund projects. I'm going to hand over to our great panelists, Susie and Osama from Baker McKenzie shortly. But first, I'm just going to quickly go over some house rules. So please use the online question tool to post any questions that you have, and I'll be posing them to our speakers at the end. David Rowe, the Graduate Recruitment and Development Officer at Baker McKenzie, is also joining us today, and we'll be happy to answer any recruitment-related questions that you may have. Please note that this masterclass is being recorded. The recording of the session will be sent to all registrants after the session in a follow-up email, and it will be also available on our YouTube channel very shortly as well. Okay, so with that out the way, I'm just going to start off by asking all the attendees to answer the question on the screen, so our panelists can get an idea of who's joining us today. So there'll be a poll popping up on your screen right now. If you could please go ahead and answer that. So the question is, what stage are you at? I'll give you a few seconds to pop your answers in. Thank you to everyone that's already done that. Okay, I think that's almost majority of you. So I'm just going to share the results. So it seems we have quite a split with 18% of first-year law students, 14% second-year law students. We also have a lot of postgraduate and people in work. Thank you a lot for sharing these. I'm just going to run one more poll, which will be asking how much you already know about private equity. So if you could do the same on this poll as well, please answer on the screen. So how much do you know about private equity and funds? Would you say you're an expert? Would you say you know a little? Or would you say you know nothing at all? Okay, thank you everyone for answering. Seems like majority of you said that you know a little, and some of you have said nothing at all. And we have some people that have said you're an expert, which is great. So with these polls out of the way, I'll gladly hand over to Susie and Osama for this excellent discussion. So off to you.
Thank you, Dimitar, for that introduction. I'm delighted to be here with my colleague Osama. We'll probably start off with just a quick intro on who we are and what we do at Baker McKenzie. So I'm Susanna Beard. I'm of counsel in the private equity and funds corporate subgroup at Baker's. I joined the firm, so I'm a lateral hire. I joined the firm just over 18 months ago, having previously been at the London office of a US firm for about 12 years. My experience prior to joining Baker's was similarly corporate transactions, M&A, and private equity. But in a past life, early on in my career, I started out as an energy lawyer, doing oil and gas transactions. So I've had quite a varied background, but almost wholly within corporate transactions. Prior to that, I was an indirect law graduate. So I did a non-law degree in geography at the University of Leeds. And then when I graduated, I took the GDL route and then did LPC before commencing my training contract with what was a legacy firm called Hogan and Hartson that subsequently merged with Lovells to become what we know as Hogan Lovells today, back in 2009.
Thanks so much for that, Susie. Hi, everyone. My name is Osama, and I am a third C trainee solicitor at Baker McKenzie. I studied Scots law at the University of Glasgow, which was a 4 years degree, following which I proceeded down the partial GDL and LPC route. Since joining Baker McKenzie, I've completed seats in real estate and banking and finance. And yeah, I'm currently in PEF. Brilliant.
Thanks, Osama. So just a quick overview of what we hope to cover in today's session. So we're going to tell you a little bit about Baker McKenzie as a firm. And then the real learning objective of this session is to just give you an overview of private equity. I'm somewhat terrified that some of you are already experts, so please correct me wherever I go wrong. But for those of you that aren't, don't worry. Please submit some questions. No question is too small or too simple. So do let us know if anything isn't clear. But the idea is to demystify some of the jargon and explain how a typical private equity transaction might work, and how deals tend to proceed. And then Osama is going to tell you a little bit about what he's been doing as a trainee in our team. And then we'll tell you a little bit about the clients that we have and the roster of clients that we service on a day-to-day basis. So Baker's, Osama and I probably have slightly different sort of answers to why we applied to Baker's, because Osama obviously came through the graduate recruitment route. I've obviously joined as quite a senior lateral hire, sort of further down my career path than his. But I hope we've probably got some similar answers in terms of why we chose Baker's and why it appealed to us. For me, it was about joining a much bigger platform than the firm I was previously at. I wanted access to, more global opportunities, a more collaborative workplace where I was able to work with different offices around the world, but also different practice group areas. So, for example, Baker's has an incredibly highly regarded tax team. Some of the work that I do is in the family office space. They also have a wealth management team that's very popular. So it was about complementing my principal practice in private equity with other practice areas where I could expand my practice, meet new clients, and work on new and different transactions. And really, Baker's just ticked a lot of those boxes, given its global reach, the larger headcount that it has, and the impressive roster of clients that it has. All of those statistics are impressive, but from a personal perspective, the reason that I applied to Baker's and ultimately chose to join Baker's was for the people and for the culture. Everybody I met was, very human. There's a very human side to the firm. There's a very collaborative side to the firm. And that really attracted me. I just liked everybody that I met, and I felt that I could get on in this workplace. And having been here for 18 months now, that has really stood out in my time here. Once you join, you get to sort of see behind the velvet curtain, so to speak. And I have to say, I've experienced exactly what I hoped that I would in terms of the culture here and the collaborative nature of the work that you do. I don't know, Osama, whether you can add to that in terms of your experience of the recruitment process and why Baker's.
Yeah, no, definitely. I think I did a VAC scheme back in 2020, and that was my main initial insight into the firm. And I think you essentially hit the nail on the head, Susie, in relation to both of those points. So first of all and probably the biggest point for me would be the culture. Not just because, it's nice to be in a place of work where you genuinely get along with your colleagues, but also because from a learning perspective, it just makes it that much more easier and sort of more beneficial from a learning perspective, that you can really understand, the points being raised by associates and partners. I've had on several occasions throughout my TC times where we've been in meetings and the partners, stop the meeting and say, just to explain what's going on. And then they basically explain through the whole process and then they sort of like go back into the discussion points as to what the next actions are going to be. So I found that, everyone, no matter level of seniority, is very willing to take their time out to help you learn and really grow and develop as a solicitor. And I think, that's one of the key things I found in the VAC scheme, and that has echoed throughout my TC as well. In terms of, the firm generally, and, why I chose Baker's around the work, is because of the international aspect. And again, that sort of echoes throughout all aspects of the work. The main one being that when we're sort of carrying out due diligence exercises or, large global transactions, very often trainees are the ones who have the responsibility of reaching out to the local offices, liaising with them, liaising with lawyers in various different jurisdictions. I think it was probably within a few weeks, I was being sent to different offices across the world. I've been to Riyadh, I've been to the Dubai office, I've been to Milan, I've been to Rome. So, I've had a lot of international exposure thus far, and, I'm only around halfway through my TC right now. And then obviously on top of that as well, when you are liaising with lawyers, you get to, I suppose, understand things from a different perspective that you wouldn't really get at other firms. So, for example, you get insights into, French law, Italian law, Spanish law, and that really helps you understand the various problems a global business has that much more. So yeah, for me, it would have to be those 2 points: is the culture, and then also the global reach of Baker McKenzie.
Thanks, Osama. And I think the only thing I'd add to that is, we live in a sort of rapidly evolving world from a technology perspective. And what I've really found about Baker's in an industry which can sometimes be quite traditional and conservative in nature, Baker's is very willing to embrace sort of new ways of carrying out your legal services, and particularly, as AI develops and legal tech tools come to market, Baker's is not shying away from those, but is embracing those and saying, well, how can we support our lawyers in providing the best service and give good value for clients? Because we are able to review large swathes of contracts using an AI tool, which might otherwise take a trainee hours and hours to review. And instead of shying away from that and seeing it as a sort of a threat to our service base, but actually leaning into it and working out safe and appropriate ways to use those technologies in our daily work. So moving on to the sort of core of the session, what is private equity? And I think the first thing to say is there is a huge amount of jargon in this industry. People like to use, buzzwords, they like to use acronyms. So it can often be very sort of confusing and mind-boggling just getting to grips with what's actually being talked about. So the fundamental question, what actually is private equity? So private equity is essentially financing an investment where the source of the money for the funding of that investment is a fund that has been specifically formed. So the capital raised to go into that fund is specifically formed to invest in private companies, so shares in private companies. And you can differentiate that to public equity investing, so the sort of shares that a retail investor would be able to buy on the stock exchange. And it's typically characterized by realizing high returns and over a fairly short period of time. The private equity life cycle is quite short, typically 8 to 10 years, with a view to selling that investment to realize those returns by way of a subsequent third-party sale, or even by listing the business on a stock exchange so that it becomes a public equity. So private equity firms themselves, you often hear them referred to as financial sponsors. These are the sort of investment management firms that are raising money from outside investors. They manage that money on a day-to-day basis. They manage the investments that they make. And you might hear them referred to as GPs, because they are the general partner and is what typically is structured as a limited partnership. And Osama's going to talk a little bit about some of those terms in a moment. But limited partnership is the legal structure that's more often than not, particularly for a UK financial sponsor, used to aggregate the investment in a fund. Occasionally, you get some listed companies investing balance sheet money, but that's more rare. Certainly in terms of the work that I do, I would almost always see an LP structure with the financial sponsor as the GP, which manages those monies. So in terms of the PE life cycle, as I said, it's a fairly short cycle. It's not for long-term investing. And it starts with the financial sponsor going out to find investors and raising funds. So typically each fund is formed for a particular investment or category of investments. So they may be interested in a particular type of investing. For example, it may be an infrastructure fund. So that will typically look for investments within the infrastructure space. And the financial sponsor will go out and look for investors, or LPs as they're often called, to raise the capital. And they will often set a limit in terms of how much capital they're seeking to raise for one fund. So this can be, starting at sort of, in the lower millions up to, potentially £1 billion for a large fund. There are obviously much bigger funds in the market as well, the BlackRocks of these worlds, the GICs of these worlds, who raise, very, very large funds. So once that capital is committed, the investors commit to investing a certain amount of money to the fund. The fund manager, the GP, will go out into the market looking for those deal opportunities. Now, private equity, although they may have a particular focus for a fund, in general, they tend to be quite sector agnostic. So what they're looking for is value. So what will the return on the investment be? And they do a lot of statistical analysis on that before they invest to work out what the returns could be for their investors. And they tend to be very picky about what they invest in, and only investments that they evaluate to return a particularly high return on the investment, or IRR as it's sometimes referred to, will make the grade. And then the GP will draw down on the fund. So the capital that's committed by the investors will be drawn down to invest in a particular private equity business. And that money will be used to expand that business, to grow it, maybe to move into new markets, to bring different products to the consumer, for example. It may be about managing the investment carefully to reduce cost. So it's offering better value for shareholders, with the ultimate view that they will be seeking in a fairly short period of time and what's known as an exit. So an exit is some form of sale, or it may be a listing on a stock exchange. And that is the way that you return your value to your investors. And those investors will then often seek to reinvest that money. So you will find there is a regular cycling of capital through the private equity system. So when the investors receive their return, they may reinvest some or all of those funds in a new fund that financial sponsor or another financial sponsor is raising for new investments. Just move on to the next slide. So as I said, private equity jargon, there's quite a lot of it about. So perhaps we can give you a quick run through of what some of these terms mean. I don't know, Osama, if you can start with the left-hand side of the wheel and just give us a top line on what these terms actually mean.
Yeah, of course. Thanks very much, Susie. So as Susie mentioned, most funds in the UK are structured as limited partnerships. And within a limited partnerships, you have different classes of partners, being limited partners, LPs, and general partners, GPs. Now, GPs, the general partners, they're essentially the ones that manage the private equity fund itself and make all of the key decisions around investment strategy and whatnot. They have unlimited liability, which is the sort of drawback of that. And then you have the limited partners who are more of passive investors. So they'll essentially invest money into the fund, but they won't necessarily have any say in the investment strategy or sort of the direction that the fund will take. But they benefit from limited liability. So essentially, their liability is limited to the amount which they've invested into the fund. So that's LPs and GPs for you. Leveraged buyout. So this is essentially looking at a way in which a private equity fund would purchase a company or purchase an investment. And that would be done by using primarily debt. So anywhere between 60 to 80% of the cost of the company will be paid for using a loan that's been obtained from a bank or some other source. The question is, why would a private equity fund want to purchase companies using debt? The main one is to sort of increase their return on investment. If a company, for example, is worth 100 million, if the private equity, pays for that directly using all equity, they're essentially tying up a large amount of their funds in that investment, which again, they might not see a return on until 5 or 8 years when they come to exit, and sell that company. So that's why very often, instead of using equity to purchase the companies, they would use a large proportion of debt and essentially leverage the assets of the company, in order to do that. Looking at a management buyout. So this is very often where the management of a company would approach the private equity fund and say, we would like to, purchase this company with you. And very often the management then would also sort of take shares within the company, and they would sort of become the owners. And sort of the plus points or the benefits of structuring it this way is that the management very often have key insights into the business, how it operates, where it can improve, where they can increase profitability and how they can sort of increase the overall value of the business so that when they do come to exit in 5 to 8 years or whatever the time range is, they can really sort of add value in their own way. The sort of downside as to why management can't do it themselves, I suppose, is because they don't really have the capital required to fund the acquisition of the company. And that's sort of why very often the private equity funds will also step in and provide that capital and also obviously provide their experience wherever needed as well. So that's essentially a management buyout. Due diligence. So when very often private equity funds, they're either purchasing or selling a company or investment, they will carry out due diligence, and this can take different forms and can be looked at in different ways. So for example, if the private equity company is looking to purchase a company, they would carry out due diligence, which is very much looking at, what sort of risks come with this business, what sort of red flags, if any, are there? Is there anything that's going to drastically decrease the value of the investment? And when they're carrying out DD, they're essentially looking at, big things. So for example, it could be smaller things as well, but a lot of the times they're looking for things that are going to be deal breakers, and really harm the value of their investment. Whereas if they're at the stage where they're looking to sell, a company which they've acquired, they still may do DD, but they'll sort of do it in a different form. where they're looking to look at everything in a non-alarmist kind of perspective, where they're flagging, there's this issue, but it's not that big of an issue because of X, Y, and Z. And that's really so that when the buyers are looking at the business from an external perspective, we're trying to, downplay all of the issues as much as possible. So yeah, it's essentially raising the different issues or red flags that come with a business. Yeah, I'll pass over to Susie to discuss the rest.
Osama. So waterfall distribution. This really is where the magic happens in a private equity style transaction. It's sometimes also called a liquidation preference. I have to say, I imagine it in my head like a stack of sort of champagne glasses at a fancy gala, where the champagne is sort of flowing down from the top to the bottom, filling the glasses as it goes. And essentially, it's a strict hierarchy that will be written into the documentation, which sets out who gets returned what when the company is either sold or is listed on the stock exchange. And typically, it works as follows, so that firstly, the investors get their initial capital commitment back. So what money they put in to buy the company, they get that back out. They then typically get what's known as the hurdle rate. So in private equity, this can be quite high, can be between 18 to 20%. So that's the upside on their investment. And it's only after that any other interest holders will get their returns. So this links into the bottom entry, the carried interest. So the GP, who essentially has done all the hard work of bringing the investment to the investors, managing that investment, securing the exit transaction, they then get their carried interest payment. So they will, after the hurdle has been reached, they will then get their percentage interest. And then it flows down. There may well be a management interest. So the management may well have been incentivized by way of some management incentive scheme and have shares. So they will then get their interest. And then whatever's left at the bottom will then be shared in different proportions. And how that waterfall distribution works will be quite heavily negotiated. It will be very carefully modeled for different eventualities. It will take into account the debt, because as Osama pointed out, very often private equity transactions are leveraged. So the debt that's in the business will need to be repaid, and that typically ranks ahead of the equity. So the waterfall will only pay out after that debt has been repaid. So the waterfall is a very important term of art to know. It takes a bit of working with to get to understand. You see lots of different permutations, but the basic structure is that the investors get their investment back first. They then get their upside, and that's when the GP gets to participate in the profits. Portfolio company, or portco, as you'll often hear it referred to, this just refers to the investment company, the company that's been acquired. It will typically form part of a wider portfolio. Often private equity sponsors will acquire several businesses in the same sector or industry because there are efficiencies to be had by consolidating different businesses and sharing resources and streamlining them accordingly, and that's where they will find their uplift. Dry powder. This is another term that gets bandied about a lot. It was in the press, the financial press, a lot last year. It refers to the amount of capital that has been committed by investors to the fund that has yet to be invested, that has yet to be allocated to a specific investment or spent. Last year, M&A activity was difficult. Private equity sponsors were finding it hard to find good deals in the market. So you saw a lot of press around there being a lot of dry powder. And dry powder is essentially money that sponsors have to spend, but they haven't found something to spend it on yet. And the reason that it can be a problem, it sounds like a good problem to have, but it can be a problem is that if it's not invested, it's not working hard for you, it's not making money on that money, and the whole private equity system is based on money being invested, increasing over time, so that money comes back out of the system, having increased in value, and then can be reinvested in new investments going forward. So that's quite a common term that you hear come up, and just refers to committed but unspent capital. Carried interest, as I referred to before, goes hand in hand with the waterfall distribution. And this is the GP's upside for the hard work that they do. So if they make a successful investment, if they increase the revenue of the business they've invested the investors' money in, if they reduce costs so that when they exit, the value in return to investors is high, they're likely to get their carried interest, and that's really where their value comes in. But typically also they get a management fee, so a small percentage of the investment value that they are paid to operate the underlying portfolio companies. Next slide, please, Osama. Thank you. So private equity transactions, although they follow a similar life cycle as I explained before, they can look quite different depending on what the underlying investment is and what stage it's at. I would say most predominantly, we look at buyouts. So this means a controlled transaction where the private equity fund is acquiring a majority stake in the portfolio company. Usually private equity sponsors like to acquire the entire entity because that gives them full control, and also the full exit value when they come to sell it. It's not always possible to do that, to achieve that, and there are various different reasons for that. Sometimes you'll be buying from founders who want to retain an interest in their business, and the private equity sponsor will have a vested interest in keeping them in the business because of their expertise and knowledge of their own business. So it can sometimes be a symbiotic transaction where the founders retain a minority stake, they stay on in a CEO or similar position, and continue to take the business forward. Now, a buyout might be a primary or a secondary transaction. A primary transaction just means that it's the first time private equity has bought this business. A secondary transaction is where private equity is acquiring from private equity. That's what a secondary transaction means. And then you may get other types of investing, particularly in early stage businesses. So you'll hear about venture capital or seed capital, sometimes called Series A investments. These tend to be very high risk, but can be very high reward, so returning even more than your standard private equity return might be. And typically that's why private equity sponsors will hedge their investments, so they may invest in multiple VC businesses, but only put in small pots of money into each. And so that way they mitigate and manage their risk profile, but still give themselves exposure to the high returns should that venture capital investment be the new, ChatGPT or whatever it may be. So they're always looking to get into those opportunities early, so they've got the time value of money to get in whilst the investment rounds are small and relatively cheap. Development capital, this is a type of transaction where a company's got to a stage where it has an established business, but it needs more capital to grow that business. So as I said before, it may be taking its business to a new market, or it may be launching a new product, or they need new investment to make R&D developments to expand their business. So they're not typically control transactions. It's when new money is coming into an existing business, and private equity may just take a minority stake. And whilst it gives up the control aspect, it's still participating in the exposure to the upside, and can be more of a passive investor in those circumstances. So corporate venturing, so this is where corporates invest in VC or growth stage companies alongside VC investors. They can bring not just capital, but they also bring other resources, and they may even bring business opportunities, so they can expose their own customers to the VC business and the benefits it may bring. So again, it's one of those relationships that can be considered more of the joint venture type, where both parties stand to gain something from the investment, and it's not a purely financial arrangement. So what distinguishes private equity from strategic M&A? Well, firstly, strategic M&A is where one corporate may buy a business from another corporate. You see it typically in consumer or pharmaceutical businesses where, Unilever may buy a brand from Procter & Gamble, something like that, where, they feel that brand fits strategically with their business. They agree a price. It's a bilateral transaction between a seller and a purchaser for a target company. And it's relatively straightforward in terms of the number of different stakeholders who are involved in that transaction. And I think what really distinguishes private equity transactions is the number of stakeholders that are involved in that transaction. And what we as lawyers need to do is to balance the interests of all of those stakeholders. Obviously, we're representing the needs of our client, which is typically the financial sponsor, the GP. But we have to be cognizant of all the other stakeholders, because part of our job is to get the transaction done, and to consider the other stakeholder interests, and to find alignment where we can, whilst making sure that your client's interests are protected. And you can see from this slide just how many different sort of interrelationships that there are. So the private equity sponsor will have raised the private equity fund. That is the capital commitment that gives them some of the funding to make the investment to acquire the target company. But they will also be negotiating financing, third-party financing with the banks. So the banks need to be comfortable that this is a target company that they want to hold security in, that they want to invest money in themselves. So you have to manage their requirements. They will have an absolute shopping list of requirements in the transaction in terms of due diligence requirements. They will also want to review the transaction documents. There will then be the financing documents themselves, which will be full of financial covenants and other restrictive covenants, which are basically restrictions in terms of what the fund and the target business can do whilst it is a borrower of their money. Management is a very important stakeholder group to consider. So sometimes the management of the target being acquired will stay on, and they may also reinvest, particularly if they have had shares in the business through an incentive plan. They may be asked to reinvest that money in the buyer. So they will have an interest. They will want to see where their interests come in the waterfall distribution. So there will be multiple negotiations going on simultaneously. The LPs behind the fund will want to know what's going on. Although they are passive, they are not allowed to get involved in the management of the investment. They will want to know how their money is being invested. So the GP will be in constant communication with the investors in terms of what the investment looks like, the quality of that investment. They'll be talking to management. Management have the best view of the business that's being acquired. So you will spend a lot of time with management, learning about the business, what they foresee as the potential, future issues for the business, where the potential upside is, how the business works, where the problems are, what the capital that's being invested could be used to invest in and for operating improvements, etc. So you can see that, there's a lot of things to consider when you're negotiating a transaction. And I think that's where the key distinguishing characteristic is with strategic M&A, where you're typically a few parties, a buyer party, a seller party, the target diligence, and you'll often see those transactions being done what's called on balance sheet. So the acquiring business just uses cash in its own business to buy the company, and you don't have to negotiate with the banks as well. So it's what can make a private equity transaction quite complicated, and it can also take some time to get all of this done. But the sponsors are often really keen to get their money invested as quickly as possible. So these transactions can move at great speed, and you're often spinning quite a lot of plates at one time to make sure the transaction timeline moves as quickly as the sponsor wants it to. So key deal stages. So when the sponsor has identified the deal opportunity, they'll start looking at that deal, and they will carry out very extensive deal feasibility studies. A lot of this will involve much cleverer people than I doing very, very complicated Excel modeling to determine what the returns might be in different economic weather conditions. So there will be a lot of modeling of that sort done before really even the negotiations start. If you're on the sell side of a private equity transaction, it's really important to demonstrate to a private equity buyer that you have your ducks in a row, you know exactly what you're selling. That is often easier said than done when it's private equity buying from a strategic corporate business, because it's not always the case that all the assets that are required for a business are actually owned by the company that's being bought and sold. And so you'll often see that there needs to be a lot of pre-transaction restructuring, moving things around to make sure that the right assets are sitting in the right company that's going to be sold, and that assets that you don't obviously want to sell are moved out of a company that's being sold. That will be going on kind of in parallel to the preliminary document negotiation, and this is typically confidentiality agreements, or NDAs as they're often referred to. Sometimes you see exclusivity agreements. I have to say, in the current market, exclusivity is quite rare. You're doing very well if you get exclusivity. Everybody wants to elbow out the competition. So if you are able to negotiate an exclusivity period, you're doing pretty well at the moment. And those exclusivity periods are usually used to negotiate the key terms of the deal, usually on a non-binding basis. So these might be referred to as heads of terms, an offer letter, a letter of intent, something like that, a non-binding bid. And these are the sort of key deal terms. Obviously, the number one on that list is usually price, but it's really important when looking at those sort of documents that price isn't the only factor that you look at, because there will often be quite a lot of assumptions or other requirements of a buyer, which may or may not be palatable. So price is obviously important, but it's not the only deciding factor. The types of documents you have will depend on whether it's what we call a bilateral transaction or an auction process. Osama's going to talk a little bit about that in the next slide, but essentially a bilateral process is where one buyer and one seller negotiate to sell a target business, and an auction process is just how it sounds, where a vendor invites multiple bidders to bid for a particular asset. And that is where you'll have a more complex process, because you're obviously dealing with more bidders. So you will have a process set up. You'll agree a sort of a teaser document in advance, which sets out, this is the business that we're selling. This is what it comes with. this is why we think it's a good deal, this is why we think you should buy it. And that will be prepared usually alongside the target business's accountants or advisors to provide the financial information, which is usually the first thing private equity sponsors will want to look at. All being well, things go ahead, you get some interest, or if you're a private equity sponsor, you think, yes, this business looks good to us, then you'll kick off the due diligence process and negotiations. So due diligence, as Osama explained, this is where you get to kick the tires on the target business. You can also ask questions. So there'll often be a data room set up where all documents relating to the business, their key contracts, their registers, you want to see the share register, who owns the shares, is it all in order? So you review all those documents, and our job as a law firm is to set up a diligence team and coordinate across all the specialist areas. So tax, employment, intellectual property, commercial. You'll have somebody look at the litigation registers and see if there's any ongoing proceedings, for example, as well as the corporate diligence on the company, just to make sure that there are no major red flags. And if there are, you obviously raise them to the sponsor. It doesn't necessarily mean they're deal breaking, but you then think of ways that you might want to address those issues in the documentation. Something important to consider is merger control and the FDI analysis. Merger control is where the competition authorities will look at the deal and decide whether or not they think the combination of the purchaser and the target is good for the market, particularly if you're buying large businesses. So when you see, things like Deliveroo trying to be, acquire DoorDash and things like that, then, the antitrust authorities will look at those transactions and decide whether holistically that is good for the marketplace. Is it good for the consumer that those two companies are owned under one umbrella? A growth area is FDI analysis. More and more countries are bringing in their own regimes for foreign direct investment. Obviously, in the UK, we have something called the NSIA Act, so the National Security and Investments Act, and that adds guardrails around who is allowed to acquire certain businesses. So, for example, there are certain jurisdictions where it would be more difficult to acquire sensitive assets. So in the military space, the defense space, in AI tech space, investors from certain jurisdictions will be carefully assessed to determine whether that poses a threat to national security. Transaction documents, that's obviously something that we look at in great detail, that we will often draft from scratch. Typically, the buyer drafts the first draft of the transaction document, the SPA, we call it. Sometimes you will have an auction draft if it's an auction process, and in that case, the vendor has a little bit of the upper hand by drafting the sale agreement and putting that in the data room to be reviewed. Sama's going to talk a bit about that as well. And then if you're happy with the diligence process, there's nothing come up that you think you can't live with or address in the documentation, you will get to the implementation phase. And this is where you sign an agreement. More often than not, certainly in deals that I see, you will have a split signing and closing. It's very much like when you buy a property, you will sign the purchase contract, but you don't actually complete and pay the money until certain conditions to completion are satisfied. Most often, the financing is one of those conditions. You need to make sure you've got all the funding in place. Particularly as a financial sponsor, you need to make sure you've got time to draw down from your investors. So you'll make a capital call on your investors and say, hey, we've signed this deal. We now need to fund this deal. And you need to give your investors, time to obviously deliver those funds to you. You can't just be asking for £50 million overnight. There will also be often multiple closing deliverables. These documents that we as a buyer would like to see on closing, things like board resolutions, stock transfer forms. There may be directors resigning, new directors going on boards. You might be changing the registered office. There may be ancillary agreements that you need to deliver, for example, IP license agreements or various other commercial agreements that are part of the transaction. And the last phase, when all of those things have been satisfied, is the closing and the funds flow. And this is when the monies that you've drawn down from your investors and well as the banks is paid over to the seller, and you acquire the shares and go off and start to run that business. So that's a quick whiz through of the key stages of a private equity transaction.
Brilliant, thanks, Susie. So yeah, one of the key considerations when a private equity sponsor is coming to exit and sell its investment, sell the company, is the process in which it's going to sell it. Now, it can take one of two forms, being either a bilateral process or an auction process. And as Susie very correctly pointed out, a bilateral process is essentially when there's one purchaser and then one seller. You know, there's two entities. Whereas an auction process is where the seller invites a number of potential bidders who I think may be interested in purchasing the company to, you know, take part in a number of different stages to eventually submit their bids and then purchase the company. Now, depending on the situation of the private equity sponsor, you know, there's advantages and disadvantages of both. The main advantage of the bilateral process is essentially when the private equity is that it's quick. So if the private equity sponsor is looking to sell the business very quickly and see a return on its investment within a short period of time, the bilateral process speeds everything up because, again, if there's one seller and there's one buyer, it's much easier to negotiate the documents. It's very clear as to, you know, what the sort of breaking points of the deal are, and, you know, those can be discussed and hammered out very, very easily. Obviously, the drawbacks of that is that where it is a bilateral process, there's not as much competitive tension. And very often that also means that you would get typically a lower sale price for that company. So I guess the main sort of question is, you know, speed and also, you know, efficiency compared to maximizing value for that business. With an auction process, it differs slightly. So again, there can be multiple stages of the auction process. And very typically, there is what is known as a preferred bidder. So preferred bidder is, for example, one purchaser or, you know, one potential purchaser who the private equity sponsor knows that, you know, these are the main guys who are going to pay the most for this business. And, you know, the reason they still choose to do it through an auction process is, like I said, is just to sort of build up that competitive tension and ensure that they really are maximizing as much value as they can to really, you know, see as large of a return on investment as they can. So the way this would be structured is that they would initially, you know, reach out to a number of different potential bidders with sort of, you know, a document that sets out the particulars of the business, just to give them an idea of, you know, this is the background to the business, this is the management, this is the forecast of, you know, where the business is looking to go in 5 years' time or 10 years' time. And this really just gives all the potential bidders the necessary background without giving too much information away. And the reason for that is very often these potential bidders are or can be competitors of the target business. And so if they sort of release all of the sort of market secrets or, you know, insights that they have, and then the potential bidders don't end up proceeding with the purchase of the company, you know, they've really given away quite a few trade secrets. So at the initial stage, it's just to sort of give a very, you know, high level overview of the business and how it operates. From there, you know, the private equity sponsor will invite all the bidders to sort of give indicative bids as to, roughly how much they would be willing to bid. And again, it's not binding, so it's not sort of tying in any of the bidders, but it's just so that they can get an idea of, we have 3 or 4 people who are serious about this transaction or have, serious bids that we would consider. And at that point, they can then consider, like Susie said, having the bidders sign NDAs and whatnot, and releasing more information to them, such as, for example, the financials of the business, and sort of like more trade secrets and whatnot. And from there, it again proceeds. They may have 1 or 2 additional stages where they sort of reduce the number of bidders in play, and essentially that ends with one preferred bidder being chosen. Yeah, and essentially that's that. Another key benefit of the auction process is that the seller is driving the process. They control essentially the documents, especially when it comes to the transaction documents like the SPA, the sale purchase agreement. They can say to all of the bidders, this is sort of what we're proceeding with as the initial first draft. Obviously, they'll invite comments and whatnot, but it means that they are very much in the driving seat because, again, of that competitive tension which is in play. And again, this is sort of looking at the sort of work that the private equity team does at Baker McKenzie, and how sort of involved they are with the various other offices and departments. So as we mentioned, one of the key things about Baker's is that we have a very large global reach. And the benefits of that is that very often we're able to advise on, cross-border transactions where there's, several different jurisdictions, very often, 30, 40 different jurisdictions involved. And one of the plus points of that is that, especially as a trainee, is that very often we are helping liaise with those offices to try and, carry out our due diligence. So to give you an example of how that would work is that us in London, we would sort of we would be lead counsel. We would sort of run point on the transaction, and the private equity team would reach out to all of the other departments in London that would be involved in the transaction. So, for example, IP, pensions, real estate, banking, etc. And we would say, these are all the documents we've received in relation to the purchase of this company. Please, can you look to review? And at that point, all of the main contacts in London would then reach out to all of the various local councils. So again, if it's a, large cross-border transaction, they would reach out to local council in the likes of, France, Spain, Germany, the US, and reach out to basically all of their relevant counterparts in those jurisdictions. And that way, the private equity team has quite a large role to play in organizing and coordinating the transaction, not only from a London specialist perspective, but then also, looking at and reviewing the input received from local council in relation to all of these different departments as well. So it's a very big sort of coordination role that we play. To quickly touch on the role of the trainee. So again, trainees are given quite a lot of responsibility within the private equity team. A lot of our work does come down to sort of coordination and liaising with local teams. Now, again, that can be both from a corporate perspective. So when we reach out to local council, one of the key things and key red flags that we need to consider in our due diligence is from a corporate perspective. Looking at the shareholding, looking at the directors of a business, and making sure essentially everything is in order. So very often it's the trainees who will play a big role in reaching out to local council and essentially requesting them to run different corporate searches, and asking them essentially the results of those searches and feeding those into any transaction documents such as DD reports or the SPA and whatnot. Very often we are liaising directly with the clients and advisors. So again, when clients come to us with any queries and whatnot, where we're not sure, obviously we discuss that with the relevant associate or partners, but very often we're given the responsibility of sort of running with certain work streams. And again, that can be very beneficial from a learning perspective in that you really are given that initial point of you are the initial point of contact for the client in a lot of cases, which can be really good. Another key thing that trainees help out with is due diligence. So again, like I mentioned before, in terms of drafting and reviewing due diligence reports. So again, when private equity sponsors are looking to sell or purchase a company, and we are drafting those due diligence reports, trainees play a big role in sort of reviewing those documents and ensuring that the DD reports are as accurate as possible and sort of capture everything correctly. And a lot of that is to do with, again, liaising with the different specialist teams in London and making sure, everybody's aligned on the different things that they're reporting on. There's also the possibility of going on either a client or international secondment. Now, the way it works at Baker's is that very often you can only go on secondment with a team you've already sat with. So that's why very often trainees tend to go on secondment in their fourth seat. And that can involve obviously going to an international office and doing either PE or general corporate work there. Or very often you can also go on secondment with a client and sit with their corporate / M&A team and get a bit more of an insight into how they do it, reviewing things from a legal perspective and how the client essentially wants things to be done, which can be very beneficial.
Thanks, Osama. Dimitar, how are we doing for time? Have we got time to go to some questions, or so this is just a slide of our clients which I can talk to, but I wonder if you'd rather I went to some Q&A.
Yeah, I'm happy to do just a couple of questions if you have a few more minutes, if that works for you.
Yeah, happy to.
Perfect. Let me see. Sophie has asked, you mentioned that your work at Baker's is often global. Do you tend to work with specific jurisdictions repeatedly, or do the jurisdictions you work with vary a lot in private equity?
It's a really good question. I think just by geographies, we work, a lot with our Western European offices, but we also work a lot with our Middle East offices. So I would say in my line of work, every deal I work on has a global or overseas aspect to it, whether that's where the investors are based, where the fund is based, where the asset is based, where the seller is based. So there's almost always an international element to the deals that we do. Private equity look for value rather than, very specific sort of characteristics of businesses. So they can be based anywhere. So we do tend to work repeatedly with, the Nordics. We work with Western Europe. I work a lot with our Spanish teams, our German teams, our Dutch teams. You'll often see structures, particularly on the fund side in Luxembourg. So we often work with our Luxembourg colleagues. I've done quite a few deals recently involving our Stockholm office. There's a lot of activity and interest in the Middle East at the moment. So I've worked quite a lot with our Dubai office and also with Riyadh. So we work globally on a day-to-day basis, just because of where we are, where London is versus the rest of the world. I'd say we probably work with our Western Europe colleagues most frequently. I do work with the US, but interestingly, the US transactions are often they tend to be quite national. So US transactions are US to US, or they do a lot of LATAM business. So there tends to be less transatlantic work, but a lot of global work going sort of east from London, I should say.
Thank you for that. I think I've seen some questions about the market conditions recently. One person has asked how has Baker's been dealing with the slowdown in PE and market turmoil following events such as the imposition of tariffs?
That's another really good question. I think, market conditions fluctuate over time. And I think the important thing is to be agile in those situations, to talk regularly to your clients, and what you do. And because we're a full service law firm, the departments that are quiet when there's economic difficulty will be bolstered by the departments that are busy. So in an economic downturn, disputes tends to get busy. When it's very, very busy, M&A activity goes up. Other teams may have less to do, but then they're doing corporate support work for our transactions. So for example, in the regulatory space, in employment, they'll be doing a lot of M&A and private equity corporate support. So the important thing is to be adaptable, to be agile, to keep talking to clients to see what the challenges are that they're experiencing in the market. And then, brainstorm ways in which you can help those clients. Sometimes it's connecting clients to deals. Sometimes, you can make introductions. So, law firms are well placed to weather storms because they have a lot of different characteristics and work streams. So where one department is seeing, a downturn, other departments will be very, very busy. We have a phenomenal reorganizations and restructuring team. So you often see in, a recession, for example, there'll be quite a lot of restructuring. Our banking team may be busy because people will be looking to refinance. So we tend to weather the storm by just, turning our attentions and pivoting on the spot in terms of where we're focusing our attentions for the workflow. Last year, M&A activity was quite patchy. It's really picked up in 2025. So, you just have to be on top of the market, stay aware, and then think about other ways that you can add value for your clients.
Great, thank you. I think we have time for just one more question. Just before I ask this, I'm just going to run the final poll in the background, which is about the key takeaway of today for attendees to answer. But I think this question is for Osama. Why did you decide to specialize in private equity over other practice areas? And do you have some tips to succeed in your application?
Yeah, to be honest, I've not fully decided on private equity. As you know, I am a trainee. So obviously I've done all of my 4 rotations. I did real estate first and I did banking and finance second. And the key reason why I chose to do private equity is that I thought it would complement my training contract pretty well. So during my time in banking and finance, I mostly worked on leveraged finance or acquisition finance, or in that area. And very often we were acting for private equity sponsors and helping them raise finance for when they are purchasing a target company or a target business. And so from that perspective, I thought it would work pretty well in already understanding the leveraged side of it and the financing side of it, to understand how we as a law firm provide support from a corporate perspective as well. So that was my main rationale behind choosing private equity. And then also I think, I did consider M&A as well, but I felt that private equity, especially at Baker's, you're doing quite a lot of M&A work anyway in the PE team. And from that perspective, it just made more sense for me to try and do a rotation in private equity and funds. Some tips for applying for Baker McKenzie. I would say the main one from, the main bit of advice I would give anyone is to just have some kind of USP and sort of really build on that, in whatever way you can. I think, and the way you should look at it is that, there's hundreds, if not thousands of applicants who all have, a degree or a degree, whether it's law or non-law, they'll have some kind of experience. But what you should really try and get across in your application is what makes you unique. What previous experience do you have? What previous insights do you have? And, why would those make you a better candidate? So again, it doesn't necessarily have to be law related. You know, I know people who have gone backpacking in, like, for example, Latin America for a few years. And during that time, they developed a very, very good understanding of the corporate space in Latin America. And it was that sort of insight that they were really able to leverage and discuss during their interviews and in their applications that sort of set them apart. Again, nothing to do with law specifically, but then again, I also know people who have done, you know, several VAC schemes in law, or, you know, had several different work placements in law, and that's really what they've been able to discuss and highlight as their USP. So yeah, I would just try and think of what makes you different.
Perfect. I think that's great advice. Yeah, so thank you to the attendees for answering the poll on the screen. And thank you to our lovely panelists. Before you go, just another reminder to attendees that we'll be sending out a link containing the recording session, so please keep an eye out for that. A survey will also be popping up once this masterclass is ended, so please fill that in to let us know how you enjoyed today and what other topics you'd like us to discuss in the future. Also remember to keep an eye out on LCN's events page, as we have a few other upcoming masterclasses in the coming months that you don't want to miss. And thank you very much once again to our panelists and to everyone attending, and we look forward to seeing you again next time.
Thank you.
Thank you.
Lovely. Cheers.
Right.